Mr. Anand Sharma is having total experience of 13 years in this industry, out of which 11 years is with ICICI Prudential Asset Management Company. Hi, sir.
Hi. Hi.
So, I have so many questions to ask you. Being a fund manager, it is very important to understand the aspects how an investor behaves and what is your understanding regarding investor behavior plus what you consider when you manage funds.
Sure. Sure.
So should I start with my questions?
Absolutely. Happy to answer all the questions
So
to the best of my ability.
तो सर फर्स्ट ऑफ ऑल मैं ये पूछना चाहता हूँ कि आउट ऑफ योर 13 years of experience, what is your take on investor behavior and how was your journey so far?
Yeah. So let me give some perspective. I joined ICICI Mutual Fund in 2014. So I've spent 11 years of my professional investing career at ICICI Mutual Fund, and to be honest, I have seen various cycles from 2014 to 2019 was one cycle, and then obviously we had a big pandemic which kind of changed the rules of the game for the investment community per se. And then last 4 years have been fantastic, right? Now, if I look at it, right, if I just go back to 4 years back, 4.5 years back, when COVID hit, all of us were at home. Many of us were actually worried whether, survival was at stake, right? But if you look at it, there were a lot of people, and especially in the financial markets, who entered during the time of COVID, and they've had a fantastic experience, right? Many of them opened demat accounts during that time. Many of them did SIPs in mutual funds, invested directly in mutual funds, and they've had fantastic experience over the last 4.5 years. Now, also, if you look at it, right, in the last 3-4 years or so, partly because of the way taxation in equities has been treated, obviously, a lot of it was changed in this particular budget that happened in this calendar year. But if you go back to the past, we had a scenario in India where equities had become such an attractive asset class compared to all the other asset classes that were there, that a lot of people believe that equity is a best way to generate returns and long-term wealth. So I think we have been living in an era where equity has been the preferred asset class. And as I said, right, last 4.5 years, people have had a fantastic experience. The other thing, if you look at it, right, a lot of the newer generation has come into markets for the first time, especially people in the age bracket of 22 to 25. Many of them would have gotten their first paychecks and started investing. The way they invest is very different to the way, for example, me, when I would have started my professional career or when I would have started investing, right?
Exactly.
If you go back to the late 90s, and I want to take this example because if you go back to the late 90s, data was not easily available. If you wanted some data of a company, you need to purchase a share so that you could get an annual report of the company.
Correct.
Today, all data is very easily available, whether it is the BSE, NSE website or any other public forum, right? So data today is very easily available, and a lot of the younger generation, their risk profile is definitely higher than what many of us when we started our investment career. So that is also reflective in the kind of choices that the newer generation of investors is making. However, I do want to point out one thing, that typically what happens in our industry is that there is a bull cycle and then eventually there is a bear cycle. It's a part of life. Nothing is always one way up. What goes up eventually has to come down as well. Generally, what I have seen is that investors tend to mature only when they have seen a full cycle, one bull cycle followed by a bear cycle, because that's when they actually have a full experience of how to go about in markets and stay invested for a long term perspective. So that's the most important experience that we've had. So my sense is that a lot of people who have come in the last 4.5 years fresh first time, I think they also eventually need to see a bear cycle for them to mature and then stay invested for a long period of time and make wealth.
I was about to ask you this. After COVID, जितने भी investors आए हैं, new investors, out of that, almost 70% or more than 70% haven't seen a bear cycle, right?
Yes.
So how much it will get impacted if they gone through with this cycle?
Yeah. So as you mentioned, right? I mean, just before COVID, if you look at the number of demat accounts that were present in India, India had roughly 4 crore demat accounts. Today, the number has crossed 17 crores, right? So you think about it, as you said, 75% of people have actually seen only a upward move. I think down cycle is it's part and parcel of an investor's journey, right?
Correct.
And as I said, life is not going to be a bed of roses. What goes up, I mean, Newton's law of gravity, right? I mean, what goes up eventually has to come down as well. So in my sense, at some point of time, I don't know what is the time frame. I don't think I or anybody else can predict when the down cycle eventually comes, but it will come. Right. So at that point of time, I think what investors need to understand is that wealth is going to be created over a longer period of time, and up cycles and down cycles are part of the investment journey. It's never going to be a one way.
Correct. Correct, sir. So, my second question is, in your opinion, what are the key factors that contribute to investors' reluctance to invest in equities despite their potential for long-term investments or growth?
I think that's a very important question, specifically if you look at the demographics of our country, right? I mean, if you go back to when you possibly started earning money for the first time, it's possible that me, yourself, or some of our friends and colleagues, many of us when we started working, our parents or friends or colleagues would have probably told us, hey, why don't you invest in gold, why don't you invest in fixed deposits?
Correct.
And they would have probably nudged us into buying real estate property.
Correct.
From a long term perspective. So I think in India there has always been a tendency in the past of looking at some of these other asset classes more favorably. The other point, I think, unfortunately, what would have happened is that some of the people in the past, and because financial literacy is more, I would say, a last 10-12 year phenomenon. So in the past, whether it was the early 90s or maybe even the 2000s, right, there would have been a set of investors who would have come into the market at the wrong time. They might have had a bad experience.
Correct.
And then eventually, they would end up, saying that, oh, this is not investing, this is possibly gambling.
Correct.
Right? So I think there has been a tendency in the past for Indians to not look at equity investing in a very favorable way. And part of it is because of our slightly safety first DNA as a country, and partly also because of the lack of financial information or literacy, as I might call it, in the past. I think a lot of that has definitely changed in the last 10 years. To your first question, I mentioned about the fact that the younger generation, the way they are thinking about equities is very different. I think I'll also give a lot of credit to the mutual fund industry as well. The amount of financial education, right? I mean, today, when you go to TV, right? I mean, every possibly 10th ad is a mutual fund sahi ad, right? I mean, a lot of
at next level.
financial education, financial literacy. I think they have really upped the game as far as financial literacy is concerned, and that has genuinely helped a lot of new Indian investors to come into either direct equities or mutual funds, right? Because I think that matters a lot. You need a hand holding at some point of time, because many of the people would be working professionals who might not necessarily have the time to devote to make their own investment decisions on a daily basis. Right. So I think it is very important, and I think that ecosystem, whether it is through wealth management, etc., has evolved a lot in the last 10 years or so.
Correct. Which helped us.
Which has really helped a lot. Yeah.
My next question is, what role does behavioral finance play in your investment decision making process, and how do you use it to optimize portfolio performance?
So in my view, behavioral finance is actually the most important aspect of investing. And why do I say it? A lot of people say that investing is actually as much as an art as it is a science. If investing was all about just pure numbers, possibly you don't need us, right? You can just have a computer in front who could take all kind of investment decisions.
Correct.
But what is it that makes active investing thrive and survive all over the world for a very long period of time, right? Today we are in India, where active investing is becoming big, but active investing globally has been a very big thing over the last multi-decades or so, right? And in spite of the fact that even passive investing has started doing very well, there is a large space even today for active investing. And everything boils down to behavioral finance. I'll just give an example. Today, for example, right, when markets are going up, it's very easy to be bullish, right? It's very easy to say that, oh, India is a fantastic place to be, XYZ stock is a fantastic stock to be in, XYZ sector could be a fantastic sector to be in. It's very easy to say that. But on a day when stocks are not doing well, during a phase when stocks are not doing well, it's actually your behavioral aspects which will determine whether you have the conviction on the stock, B, whether you have done the requisite number work on that stock to arrive to an investment decision, and C, whether to identify whether that particular stock or a sector is going through a bad phase temporarily or it's a permanent problem. So I think that's where a lot of behavioral aspect of investing comes in. If you actually look at it, if you go back to history, most of the wealth that people have made, and when I say wealth, large amounts of wealth, is actually by deploying large sums of money during bear markets, right? And I'll take the COVID example again, right? Even initially 1 month of COVID, the markets were just going one way down, right? So anybody who had the strength and conviction to bet on the fact that the long-term story of A, India, and B, even the world is not broken, possibly invested during that time, and they had a good experience. So in my view, behavioral finance is very, very, very important to determine how much wealth you make.
Correct, sir. Now, in between this, I just want to add one question since we have came to active and passive portion. The passive portion is increasing like anything, right? So, do you think that the new investors or investors are now moving towards passive investing more? They are looking for passive investments rather than an active management?
So in my view, the way I would look at any investment is that I think one should never put all your eggs in one basket. So I don't think I want to make a case of active investing is better or passive investing is better. I think when I'm an investor, I have an X amount of corpus that I might want to invest in the market. My personal view is that there is a space for both of them to coexist. That's the way I would look at it. I think passive does its job, right? Or passive obviously means you're going to replicate a certain index, right? So it also has its job from a consistent compounding part of view.
Right.
And what active management does is that it helps you to generate that alpha. And I think sometimes in life it's alpha which generates wealth for you. So the way I would look at it is there is enough space for both of them to coexist and work together. I don't think there is a case of active versus passive. I think it's a case of active and passive working together in tandem.
This is really a very beautiful answer that we really wanted that active is also important and passive is also important. So, moving towards the next question, sir. How do you feel? How do you deal with the feeling of FOMO, the fear of missing out, when it comes to investments?
I think that is the very interesting question. Now, if you ask me, I think that is the most difficult part of investing as well. Right now, in today's age of say social media, right, we are all flooded with data. Right, we just need to log into any website and we'll get hundred people talking about certain things, hundreds of ideas coming in, hundreds of stock tips that would also come in, right? And even the bombardment of news flow is very tricky sometimes, and it is very tough for anybody, even a person like me, for example, who's been in the markets for such a long time. Even for a person like me, it can get tough to how much noise to absorb, how much data to absorb.
Right.
But if you ask me, if history has taught us one thing, it is typically that herd mentality has mostly ended in a bad way. And I'll take 2 3 examples. If you go back to the time of 1630s, right, when the tulip mania was going on in Netherlands, it was a FOMO era, right? I mean, if one person would tell someone else that, oh, the price of tulip is going through the roof. Everybody came in at the wrong time, and most of them lost money. If you go back to the world, right, I mean, very recently, the dot-com bubble, right? The number of people who entered the tech space during the time of 2000, it was essentially FOMO, right? Because there were a lot of companies which were great, but there were a lot of average companies which got listed as well and possibly ended up having market capitalization that they did not deserve to have, purely because of the fact that they were categorized as a technology company.
Right.
So I think anybody who entered the markets during some of these times ended up having bad experience, and then that bitterness stays for a long period of time. So I think as an investor, as a person who's been in the markets for a long time, I think FOMO is something we all look to fight. Now, how can you avoid FOMO, for example, right? I would say there are 2 things. Firstly, when you are investing your own corpus in markets, obviously you have some targeted goal in mind. Now, that targeted goal, if I break it down into the simplest form, you need to possibly beat inflation. That's the number one goal. So I think you need to ensure that whatever targets, now it could, the other target could be as simple as, buying a car in the future, buying a house in the future, possibly getting your kids married in the future, so on, so on, right? Everybody can have different sets of targets. So I think you need to stay the course for your target and not necessarily get carried away by some of these FOMO advices that people will give you. The other point which we tend to use a lot in our profession is, it's very important that you need to have a circle with which whom you can confide in. Let me just give an example. You get bombarded with an information, you might feel the need or the trigger to act on that information. But if you just discuss it out with a friend or a colleague or a family member, right, it's possible that they might sometimes give you an advice which might help you to make a sensible investment decision. So I think it's, and that person could even be an investment advisor. Okay. Right? So I think you need to have a certain circle with whom you can confide and make logical investment decisions. But the most important thing is to understand why you came into markets or mutual funds in the first place. You came here because you wanted a consistent return which would beat inflation and to create wealth over the longer. I think once those things are sorted, you can avoid some of the FOMO noise that will typically come. It's not easy. I mean, as I said, it's easier said than done. Even people, as I said, people like us who work in the industry for a long time, there are times even we get worried, right? Because you tend to look at your neighbor. Oh, my neighbor is doing this. What am I doing? Right. And also, what happens is that, see, stock markets are never linear, right? So the stock that you bought might go up this year, whereas the stock that I bought might go up sometime in future, right? So I think you need to remember that markets are never linear, and once you keep all of these thought processes in mind, it can help you to avoid FOMO. So, do you apply the same with your portfolio as well? Yes, I do tend to apply this for my portfolio as well. There's just another point I want to make, right? The beauty of our markets is that I might like a stock or a sector, but today when I go to sleep, tomorrow that stock or sector could be a down circuit for reasons that I cannot even imagine tonight. Correct. And if you look at the last 4.5 years, the number of events that have happened, whether it was a COVID-19, whether it is all the geopolitical issues that we are seeing globally in the last 2.5 years, the world is unpredictable. So I think you cannot have a very short-term target when it comes to investing. You need to have a long-term horizon. So I think when I manage my own portfolio, I am very clear that I will apply certain fundamental thought processes to my personal portfolio. Obviously, being a part of the industry, I generally take my own investment decisions. The only thing that I always tend to do is that, obviously, one key thing that people always need to remember is that you invest money in markets which you don't need for some time, right? Unfortunately, what happens is that a lot of people tend to think that equities can make money quickly. They end up putting some money which they might be needing probably in a 6 months time or a year's time, and then maybe markets might not do well in that time frame, and then they end up removing that money and then they curse that, oh, equities have not given me return. So what you should do, and I also do that, firstly I remove whatever corpus I need for my future savings. I take care of all my insurance needs, whether it is a health insurance or a medical insurance, and post that whatever money I don't intend to use for some part of time, it's that money only that I invest. And generally, whenever I invest, I always keep in mind that I have to keep a 3-year time horizon. Nothing lesser than that will do. Right. If you make money earlier, great, fantastic. But generally, I would always keep a 3-year back of the mind. Back of the mind calculation. Keep 3 years. Or ideally speaking, you should have a longer horizon, but I'm taking 3 years as a bare minimum time horizon that you should keep. Okay.
So my next question is very simple. In your initial days, when you started investing, you consider advisor or you invested directly, right? I mean, you started investing direct fund into that options only.
So actually, when I started my initial investing, when I started was when I got my first paycheck. So honestly, in those days, investing was actually quite a simple thing because I used to invest initially in tax saving funds. Okay. Right. That's typically what a lot of people in India tend to do when they get their first paychecks. Obviously, in those days, you had a lot of cushion for tax saving funds from taxation perspective. So that was my first point of investment. The other point is, luckily, because my father himself used to invest in mutual funds since the time he was working. He always used to advise me that before splurging on your income, take out some money and put it in some mutual fund, whichever it might be, whichever category you like, but just put some money in mutual fund and forget about it, and then you see what happens in 10-15 years time. And luckily, right, whatever amount I would have put 15 years back, I mean, it's compounded fantastically, right? India has been a growth market. Correct. So I think definitely all the funds which I would have invested 15 years back, they've shown reasonable compounding for me. And I think that's the key point, right? Compounding, right? Because what tends to happen is that a lot of people who are not in the market, right? They try to time the market, and whenever they try to time the market, it many of the times it does not end up giving a good experience. So I think you leave the money which you don't need and then let it compound over a period of time, and that's when the magic of compounding takes over. What we need to focus on this is basically time in the market is important, not timing in the yes, market. It's the most important. Time is all that matters, not timing. You might get timing right sometimes, right? I mean, not to say that people cannot get timing right or people don't have the ability, but I think if you take a large set of people, it's time that will matter more. When it comes to consistency, yes, the time is important aspect, yes, right? Absolutely. My next question is, how would you justify investors' expectations in terms of returns, especially after the rally post COVID? So I think that's the most tricky part for us as fund managers and money managers. When we started off the discussion, I did mention about the fact that anybody who has come in post COVID has had a fantastic experience. And what has also happened is that the two best asset classes in the last, I would say, 15-20 years have been equity and gold as well, right? I mean, both have delivered fantastic returns per se, and there is today a set of people who believe that equity is the only way to create wealth. As I said, many of them have not necessarily seen a down cycle and how painful the down cycle might be. We've all seen just one way stocks going up 4.5 years. Obviously, there have been some minor periods in between where there have been shocks because of geopolitical reasons, but by and large, last 4.5 years have been very pleasant. My advice to people is very simple. If you are coming into equities, and I'll reiterate, please come in with a 3 to 5 year view. Equities is never going to be a bed of roses, just like life never is. I would say that one of the problems that tends to happen for a lot of investors is that they tend to just look at the last 4 years average returns, and as I said, data is right, very easily available nowadays, right. So they tend to look at the last 4 years returns and they tend to extrapolate it, thinking that if last 4 years have been so good, next 4 5 years can also be equally good. I would say rather than doing that, you should rather take a long term average of any particular country. And typically, if you look at the long term average of India, there is a certain amount of compounding that happens. So I think if you come into equities, don't just look at the last 4 years average or the funds which have necessarily done the best in the last 1 2 3 years. Exactly. That's typically what tends to happen. Exactly. And also, what tends to happen is that from time to time in investments, there are certain themes which do very well, right? So, and people look at the last 2 years and say, oh, this theme has done fantastic. This theme can continue to do fantastic. Right. That necessarily might not repeat. So I would say to people that, just don't look at the last 4 years and enter into markets or mutual funds. Look at the long term average before investing and take a long term view. And wealth is always created by long term view. And as you yourself said, time is what matters more than timing. The other part I would say is that it's also the job of people like us and you people like you as well in the who understand a lot of these things. It's our job to also indicate to the investor community there are times when we need to be very bullish. There are times where we need to exercise caution. So I think it's also our fiduciary responsibility from time to time that when it is time to exercise caution, we also need to indicate it to the investor community in certain way. Right. The indication can be as much through the actions that we take in our portfolios, right? So I think that is something that we also need to do, because eventually, right, in investments, right, if you have certain amount invested in the markets, if you lose 20% of that amount, to make money first you have to gain back that amount, and if you lose 20% first, you actually have to gain back 25%. Right. So not losing money is as important as making money. So I think that's something that we, as people managing public money, it's our fiduciary responsibility as well, to kind of handle this exuberance from time to time and tell people sometimes, just be a little cautious sometimes. Right. And also to remind people that equity is not the only asset class. This is a really very great answer, sir, for people to understand what has happened and yeah, what actually the basic fundamentals of investments. Yeah. Right. Uh, what is your take on the growth of financial markets in India? What supports your opinion? So again, I'll go back to some of the points we discussed earlier, right? I mean, 5 years back, India had 4 crore demat accounts. Today, we have 17, right. 17 and a half crore roughly, right? You look at the SIP AUM that is there, right? I mean, 5 years back, we had about 8,000 crores of monthly SIP. To that number has reached almost 25,000 crores. We have today 5 crore unique mutual fund investors itself. But if you look at it, right, what has changed for India in the last 15 years or so? Firstly, I think financial literacy has gone through the roof. And as I said, people like us, people like you, the entire industry has done a fantastic job of, first of all, telling people that what is this products all about, what is equity investing all about, what is investing in a mutual fund all about, and what it can do for you to create long-term wealth. So I think that education has been a fantastic step that the entire industry has taken. The other point, if you look at it, right, and I'm very proud when I say this, that some of the financial changes that have happened in India, whether it is a UPI, right, whether it is the way we have transitioned in a beautiful way from a paper economy to now practically, for at least for our industry, it's a lot of it is paperless, right? Right. If anybody who has been in the markets in 90s and early 2000s would just remember the flood of papers that they would have to see. There are times I'm sure many of our colleagues or probably even some of us family members, they might not even remember which paper shares they might Correct. Have, right? I Yes, mean, sir. A lot of it has changed so beautifully, right? The dematerialization, whether it is UPI, the banking transactions per se, the settlement, right? Today, settlements happen so quickly. There were times when we had to almost wait for a week for settlements to get done. So, all of this has definitely helped the financial markets in India to grow. And I think one more point that we need to remember is that India, when we compare to the other emerging markets as well as the developed markets, even today, a very small portion of India is still into equity investing and mutual fund investing. So, as a country, we still have a room to grow from a target population perspective. So, I think that is something that very bodes really well, for India from a long term perspective. The other point, right? I mean, when I started my investing career, most of the discussion would be centered around what are the foreigners doing in India, right? Every month when the foreigners would sell, their stakes in Indian companies, we would cry. Uh, and whenever foreigners would buy stakes in Indian companies, we would end up rejoicing. Yeah. So the only number we used to focus at one point of time was this FII inflow and outflow number. Yes, right. Now today, if you look at it, right, the Indian mutual fund industry is very mature. And when I spoke about the SIP book, every month we have this quantum of SIP which comes into funds across the industry. Correct. So you have a certain corpus that is there, always to be invested. You have the Indian retail investor, which is far stronger than what he or she was 10 years back or 15 years back. Obviously the Indian HNI investor also. So I think from that perspective, there has been a lot of maturity that has come into the Indian markets per se in financial industry, and I think we still have a long way to go there. Because, as I said, if you compare us to the developed markets, the number of people who are still investing, whether it is mutual funds or direct equity, is still quite low. So there is definitely a scope for that itself to increase over the next 5, 10, 15 years.
So, what is your advice to the investors at large and how they can ensure their future through equity investing and mutual funds?
Yeah, I think that's a very relevant and important question. And I, start off by saying a comment here. Both equity investment and life is not a 100-meter race. It's a marathon. So, as I said, wealth is never going to be generated in 1 to 2 years. You might be lucky at times, right? If you have a fantastic 2 years of bull market, you might actually generate all the wealth you need in those 2 years. But for a large part of the population of the country, wealth is not going to be generated in a very short amount of time. It will take a long amount of time for you to generate wealth per se. So treat equity like you would treat a marathon, right? So a lot of time, the the key here is you start early, right? So the moment you start working, right, remove out some corpus of money which you don't want to use. Rather, I would say you force yourself to take out some corpus of money which you will invest, and just make it in good quality mutual funds, and then let it compound over a large period of time. You will have a very good experience over a long period of time. That is number one. The other thing I always tell people is that, typically what tends to happen is that, especially when it comes to both mutual funds and stocks, right? And, we had this question on FOMO discussion as well, right? A lot of times people tend to invest large chunks of their money in thematic investments. And thematic investments at times can be flavor of the season. Right. They can make you quick money, but if you don't get out at the right point of time, you could be stuck for months, years. You can't be sure, right? So I think the way I would look at any person is that you have some corpus that you are investing in the markets. You have an advisor. If you don't have the time to figure out and fix up your own investments, you have an advisor from the industry who will probably do some risk profiling, etc., for you, and advise you as to what is the right kind of investments for you basis your risk profile as well. Because I think that's a very underrated aspect of investing. The other thing is, one of the greatest things the mutual fund industry has always done is this SIP and SWP, right? So I think when you start early, you do this SIP every month, you put some money, it compounds over a period of time. There might be a period of your time where you might need to withdraw some money. So even the mutual fund industry has given you this SWP model as well. So you make use of all of these models which the mutual fund industry has given. And when you start off, don't think about the fact that you might be starting off with a very small amount. You might start off with a small amount. You can always top up, right? Because our salaries also compound over a period of time, at least. And then this majorly is for working professionals. Obviously, there would be also a large part of the business community as well who would have their own cash flows. So I think you can always start off with the smallest of small amount, and then as time goes by, you increase your corpus, and that's the way you generate wealth. But the most important thing is, out of your corpus, don't just get attached to a few stocks or sectors, right? I think you need to diversify your portfolio, put your investments in some of these diversified mutual funds or diversified indexes, etc., right? So I think diversification from that perspective, purely from an equity perspective, also is important.
So, start investing is important.
Yeah, as early as you can.
Amount is not
Yeah.
much important, actually.
Yes.
This is my last question, and
Sure.
very important question, actually. What importance will you give to the risk profiling and asset allocation when it comes to serious investing?
It is very important, right? Let me take an example, right? I mean,
Before that, I just want to ask you one more thing.
yes.
Is this relevant and the only part that serious investing can happen with these two factors?
Yes, it is. Let me tell you why. Um, Now, the beauty of our industry is that even a 20-year-old person can invest, and even a 70-year-old person, or even say an 80-year-old person, can invest in the markets and mutual funds, right? But the needs of a 20-year-old person are very different from the needs of, say, a 70-year-old potentially retired person,
Correct.
right?
Correct.
Right. So, firstly, the needs are very different. The risk profile is very different. When somebody comes into the market early into their life, right? They are looking for long-term wealth creation. So their risk profile logically should be a bit higher, right? They can possibly have more allocation towards mid cap and small cap. Maybe they can even take some uh, slightly higher risk from a thematic perspective. The moment I start having a family, I start having kids, I have to start planning for my family finances. And tomorrow, whenever I retire, I need to plan for my retirement as well. So, my needs after a certain age of a point are as much wealth preservation as it is wealth creation. So I think that in essence is what risk profiling is all about. So when uh, when you meet when you meet an advisor, right? I think the first question that typically an advisor will also look at is A, what is your income, whether it is business income or professional income, and B, what is your age. And depending on that, typically most people might look at giving you some suggestions on what to invest, where to invest, etc. So I think that is a very important determinant in my view. As you age, you have to start taking your risk profile slightly downwards. That's in my view is very important. The other point I'd like to say is that in life you should, as I said, you should never place all your eggs in one basket, and that's where asset allocation really tends to come in, right? Now in India and across the world, right, there are so many asset classes, right? You take equity, there is gold, there is fixed deposit, there is maybe a real estate as well. In India, for example, some people also tend to look at insurance as a saving instrument as well. I think at all points of time, it's very important that you need to take a call as to what should be your asset allocation at all points of time. When you're young, you can probably have a higher allocation towards equity. I would say when I say high, it can be very high as well. But as you age, obviously, you can reduce your equity allocation and start moving into some of these hybrid instruments. I think that's also one of the great creations of the industry, right? I mean, because there what happens is that the call is left to the professional fund manager. When he or she believes that markets are expensive, they themselves start moving money from equity to debt and other asset classes. And when they feel that equity is relatively reasonable, they start moving money from other asset classes to equity. So I think that that is a fantastic way to spread your risk profile across various asset classes. I have never been a proponent of putting all your eggs in one basket. Because as I said, if you want to be a full-time equity investor, you have to give the full-time time. And for people who are working or have their own businesses, right, it's logical that they will not have the amount of time, right, to look at what is happening in markets from 9:15 to 3:30 and keep track of all the events happening across not just in India but in the world, which could actually affect their portfolios on a day-to-day basis.
Well, thanks a lot, Answer. I think this is a very insightful and a detailed discussion that our viewers will like. Hoping that we will again have some more detailed discussions in future also.
Sure.
Thank you so much.
The only message I'd like to end this by saying thank you so much, firstly, for giving me this opportunity. And I once again like to reiterate that, anybody who wants to make wealth in equities should have a long term mindset. You might make money quickly, but that's not going to cut it. You need to have time in the market, and then you see the magic of compounding.
Correct.
That's number two. And always, right, I think it's always wise to spread your risk across various asset class, and not just be restricted to just an equity. There is a space in your portfolio for other asset classes, whether it be debt, whether it be gold as well. So always keep that in mind when you allocate your corpus to be invested. And last, if you don't have the time yourself to take decisions on investing, it's always best to consult a professional advisor who can guide you in a sensible and logical. So happy investing to everyone.
Thank you, sir.
Thank
Happy
you.
investing.
Yeah.